Hi guys, welcome to our last class. We're going to be starting Chapter 18. And Chapter 18 deals with deductions for individuals only. So these deductions may affect all of you, at least some of them may. So let's hope that the first one does not. It deals with extraordinary medical expenses. Now, this section is entitled Extraordinary Medical Expenses because you have to have significant expenses in order to be able to deduct them under Section 213. This is because, first, Section 213 is an itemized deduction. So you can only deduct these expenses if they exceed the new increased standard deduction, which we'll talk about in just a bit. Second, there's a high floor on the deductibility of medical expenses. They're only deductible to the extent that they exceed 10% of your adjusted gross income. The Tax Cut and Jobs Act of 2017 permanently raised this from 7.5% to 10%. As with all deductions, you cannot obtain a medical expense deduction if the expense is a capital expenditure or a personal one. Now, capital expenditure here, though, is a little bit different from the other types of capital expenditures we've been talking about. So a portion of it might be deductible. I'll come back to that in a minute. As far as being personal, for example, the cost of a facelift is considered a personal expense. So is the cost of a weight loss program if it's incurred to improve your general appearance. But if it relates to a specific illness, such as obesity or hypertension, it's then considered a valid medical expense. The cost of food is trickier because that's deductible only if it is not a replacement for the food you normally eat. Now let's take a look at the problems on pages 561 and 562. In the first problem, we have a divorced homeowner, age 55, who receives no support payments from her former husband. She fully supports her 20-year-old daughter, who has no income, lives with the homeowner, and is a dependent of the homeowner under Section 152D. In the current year, homeowner installed a central air conditioning system at a cost of $10,000, which Dr. Watson, that's not me by the way, said was an elementary requirement in caring for the daughter's respiratory problems. After installation, homeowner's home had increased in value by $4,000. Other medical expenses paid during the year by homeowner and daughter consisted of prescription medicine in the amount of $500 and doctor's bills in the amount of $1,000. Late in the year, homeowner also paid $3,000 in premiums for health insurance, but received no reimbursements under the policy that year. In A, if homeowner's adjusted gross income is $100,000 for the year, what will be the amount of her medical expense deduction? Well, there's some preliminary hurdles that homeowner must clear first before we can determine the amount of her preliminary medical expense deduction. First, question is, may homeowner take a medical expense deduction for her daughter? The answer is yes. Section 213 allows this. As the facts state, daughter is a dependent, as defined in Section 152. She is a qualifying relative who bears a Section 152D2A relationship to the taxpayer, who provides over half of her support. She has less gross income than the exemption amount under Sections 152D1B and 151D5B. Generally, this is $2,000. She is also not a qualifying child of the taxpayer under Section 152C1C and C3A, Roman numeral I. Note that since the daughter is not a qualifying child of the taxpayer, she can have a fairly significant amount of income and still be considered a dependent. The second preliminary hurdle is whether a capital expenditure can be a deductible medical expense. Now, Generally, for most purposes, at least for deductions, capital expenditures cannot be deducted. But in this case, the answer is a qualified yes. If you take a look at the regs at section 1.213-1E1, three little i's, as well as the Raymond Girard case in the textbook. In Girard, the taxpayer was allowed to deduct the cost of a central air conditioning system installed for the benefit of his child who had cystic fibrosis. This is normally considered a capital expenditure. However, Section 213 allows the deduction, but it is limited to the amount by which the expenditure exceeds the increase in the value of the house, here $6,000. So the value of the house was increased by $4,000, cost of the system was $10,000, so the difference, $6,000, may be deducted under 213. In the case of Ferris versus Commissioner, this is at 582 F. 2nd, 1112, 7th Circuit, 1978. In this case, the taxpayer installed a luxurious swimming pool for medical purposes. The court disallowed the part of the expense related to the luxury features, concluding that only the minimum reasonable cost of a functionally adequate pool and housing structure, reduced by the value it added to the home, qualified as a medical expense. In addition, if the taxpayer purchases a new house that already has a pool, no part of that purchase price may be treated as a medical expense, because that, as we've seen before, is an acquisition cost. Furthermore, if year-round swimming facilities are otherwise available to the taxpayer, then the addition of a pool may not be treated as a medical expense. Now, back to our problem. The prescription medicine is fully deductible as a medical expense. In addition, the accident and health insurance is also deductible as a medical expense. So homeowners' total expenses for medical care are $10,500. That's $500 for the medicine, $1,000 for the doctor's bills, $3,000 for the insurance premiums, $6,000 the net amount for air conditioning, total expenses $10,500. Now remember, though, that homeowner can only deduct those expenses to the extent that they exceed a floor of 10% of her adjusted gross income. Since her adjusted gross income is $100,000, 10% of that amount is $10,000. So therefore, homeowner's total 213 deduction is $500. Now this illustrates how extraordinary those expenses must be. In addition, this $500 expense is an itemized deduction. That is not a miscellaneous itemized deduction because it's listed under Section 67 at 67B5. Also, with respect to prescription medicine, you cannot simply use a credit card receipt from a pharmacy because you might have purchased items that are not deductible, such as toothpaste, hand lotion, etc. So the prescription must be a specific receipt that you must keep in your records. In B, if in the current year homeowner incurs maintenance expenses of $300 on the air conditioning system, can that be taken into account as a medical expense? Would a $150 deduction for those expenses be more supportable, assuming, of course, that daughter is still there and still asthmatic? And what about an estimate that $400 of the year's electricity bill is attributable to running the air conditioning system? Well, expenditures for operation and maintenance of the air conditioning system are now deductible under the specific authority of the regs at 1.213-1E as in egg, 1, 3 little i's, although that was once controversial. The cost of electricity is clearly an expenditure for operation, since the system would not work at all unless maintained and fed electricity. So it would seem inappropriate to allocate these expenditures in part to mere personal expense and in part to medical care, although the Second Circuit has said that a reasonable estimate will work. So I guess the answer to that just is, first of all, that the expense is deductible, and as far as the amount, it depends on what the court decides. In 2, A and B, both self-employed, went from their hometowns to Big City on business, each planning to return the next day, which A did. A incurred costs for transportation, 50% of meals, and lodging in the amount of $400. B, however, became ill at the end of his business day and remained in his hotel room for 2 extra days until he was well enough to return home. His expenses, which without the illness would have been the same as A's, came to $700. What may B deduct and on what authority? It may be possible to say that the hotel and 50% of the meal expenses while away from home are not expenses for medical care. So there's authority for this under Commissioner versus Builder, which is cited on page 559. And that if those expenses are not incurred for business reasons, then they're not 162 expenses either. However, if a business trip is extended by illness, additional expenses incurred, which are normally considered personal expenses, should be viewed as costs of carrying on the business and should be deductible under Section 162. Since A is self-employed, the deduction would be allowed above the line under Section 62A1. In 3, Sickley made frequent visits to his psychiatrist. Late in the year, he sent the doctor $6,000, indicating it was to apply against future charges for services. Wobbly checked into a retirement home in the same year. She paid the home $20,000 for the lifetime right to live in the home and receive care, including medical care. The home gave her a statement indicating appropriately that $6,000 of the charge was for medical care. May either Sickley or Wobbly deduct the $6,000 payments? Well, Wobbly probably can, but Sickley cannot deduct the payments. It is a deductible medical expense is a medical expense paid or incurred in the taxable year in which it was incurred. Thus, a mere deposit against expected future medical expenses is not deductible, as the Bassett case holds. On the other hand, an advanced payment for promised medical care may be deducted. Under Revenue Ruling 75-302, that's what the service so holds as to a lump sum life care payment to a retirement home. One thing about that, though, is that sometimes those payments are required, and that may have factored into the service's decision there. Our next section, B, is entitled Qualified Tuition and Related Expenses. Now, we have already talked about the myriad tax benefits that are available to help defray the high cost of higher education. Section 222, which we mentioned before, is an above-the-line deduction. You can take it under Section 62A18 for qualified tuition and related expenses. This includes the costs of enrollment at an eligible educational institution for a student who is the taxpayer, spouse, or deductible dependent of the taxpayer. It does not include the costs of room and board, books, sports activities unrelated to academic instruction, or courses related to sports or hobbies, unless they're part of the student's degree program. The general rules we discussed before also apply. So no double dipping, and there's a phase out of the allowable amounts. So for those taxpayers whose adjusted gross income does not exceed $65,000, that's $130,000 for married taxpayers filing jointly, the maximum deduction is $4,000. For those taxpayers with adjusted gross income that does not exceed $80,000, $160,000 for married filing joints, the maximum deduction is $2,000. This deduction is allowed through December 31st of 2020, and there is a possibility that it may be extended because it has been in the past. Now, let's look at the problems on pages 563 to 564. In problem 1, law student who is single has $30,000 of AGI prior to consideration of Section 222, and law student pays $10,000 of law school tuition in the current year. In A, what is the amount of law student's 222 deduction? Well, student's computation must disregard Section 222 as it does here. The high-end limit on Section 222 deductions is $4,000, which student may take because she's single and her AGI is below $65,000. So she gets to deduct the maximum amount of $4,000 of her $10,000 tuition payment. This is an above-the-line deduction, remember, under Section 62A18. As we mentioned earlier, students should consider whether this deduction is more beneficial than a 25A credit, and I'll come back to that in a minute. In B, same as A, except that law student uses $8,000 of a 117 scholarship to pay $8,000 of the tuition. While student potentially could be allowed a $4,000 deduction, as in problem A, since $8,000 of her $10,000 tuition was funded by a scholarship that was excluded from her gross income, her tuition has to be reduced by the excluded amount, which is $8,000. So, therefore, her qualified tuition and related expenses for purposes of Section 222 are $2,000. So since she directly incurred only $2,000 of tuition expense, she will only be allowed a deduction of $2,000. In C, same as A, except that law student is married, filing a joint return, and law student and spouse have $140,000 of AGI prior to consideration of Section 222. Since the spouses have $140,000 of AGI prior to consideration of 222, and since that amount exceeds the ceiling of $130,000, they do not get to deduct the $4,000 amount. However, they may take a $2,000 deduction in the current year since their AGI does not exceed $160,000. In 2, single law student has $40,000 of an AGI prior to a 222 deduction and pays $10,000 of tuition in the current year when 222 applies. Student asks for your advice whether to take a 222 deduction or 25A credit for the year. Student had $3,000 of withholding on wages. Disregard any consideration of the standard deduction or exemptions and any adjustments for inflation. So the issue whether to take a 222 deduction or to use a Section 25A credit for qualified tuition and related expenses depends upon a number of factors, including the amount of your tuition and related expenses, your AGI or modified AGI, your taxable income and tax bracket, and the year that is involved. Since law students' AGI, and let's assume modified AGI, does not exceed the Section 25A $40,000 limitation, or the Section 222 $65,000 floor on phase-out amounts, the potential lifetime learning credit is 20% of $10,000 of expenses to yield a $2,000 credit. and the potential deduction under Section 222 is $4,000. So the issue here is whether a law student is better with a $2,000 credit or a $4,000 deduction. So this reminds me of a story, so I'll digress here for a bit. When I was a very small child, a friend of my father's would come to visit, and he would offer me the choice of two coins, one a dime, one a nickel. So invariably, I would choose the nickel because it was the larger coin. But as time went on, I began to realize that the dime was worth more than the nickel. So, of course, that game ended. But it's a little bit like what's happening here. So, are you better off with a $2,000 credit or a $4,000 deduction? Are you better off with a nickel or with a dime? In the current year, assuming that law student otherwise has $40,000 of taxable income under Section 1J2C of the Code, law student will be in a maximum 12% bracket, and the deduction would then save her $480 in taxes. That's the tax on the $40,000 or $4,419 under Section 1J, less the tax on $36,000, which is her $40,000 less her $4,000 deduction. And that would come out to $3,939. So the difference between the two would be $480, which would be her savings with a 222 deduction. Now, the $2,000 credit is going to save her $2,000 in taxes, because remember, a credit reduces your tax liability dollar for dollar. So in these circumstances, law student should elect the dime. That is, law student should elect to use the credit of $2,000. Now, some additional factors to consider here. The phase out occurs at higher levels for the deduction than the credit, with the result that in some situations where a taxpayer has an AGI, and we assume also a modified AGI, of between $50,000 and $80,000 for a single taxpayer, or between $100,000 and $160,000 for married taxpayers filing jointly, then no credit, but only a deduction would be available. Note that if you have a lot of qualified tuition and related expenses, and your AGI is below the phase-out amounts, you may take both a 222 deduction and a Section 25A credit. Remember that you can pay these expenses with student loans and still be eligible for these benefits. So your student loan is not going to reduce your qualified tuition and related expenses. Our next section, Section C on page 564, deals with the concepts of adjusted gross income and itemized deductions. Now, we've mentioned this concept of adjusted gross income, or AGI, and we've also talked a bit about above the line and below the line, or itemized deductions. As I've mentioned on several occasions, above the line deductions are far more favorable than itemized deductions. I do want to stress, though, the book's statement that the concept of AGI pertains only to individual taxpayers. It is not part of corporate tax, for example. Also, as the book notes, itemized deductions fall into two categories. Those are miscellaneous itemized deductions and non-miscellaneous itemized deductions. Under the Tax Cut and Jobs Act of 2017, miscellaneous itemized deductions are no longer deductible. Non-miscellaneous itemized deductions are still deductible, but they may be subject to limitations, either floors or ceilings or phase-outs. In Commissioner versus Banks on page 567, if you recall, we discussed this case back when we were talking about taxation of damage awards. This is a combined case of Commissioner versus Banks and Commissioner versus Bonitas. In both cases, the issue was how to treat contingent attorney's fees awarded in a successful damage suit. In Banks, Mr. Banks was fired from his job as an educational consultant with the California Department of Education. He sued on the ground of employment discrimination in violation of the Civil Rights Act of 1964, and he won his suit. He received $464,000, of which he paid $150,000 to his attorney pursuant to their fee agreement. Banks included none of his recovery in income, and this was challenged by the service. The tax court upheld the commissioner's determination, and on appeal, the Sixth Circuit held that while the recovery itself had to be included in income, the portion attributable to the attorney's fees did not. The court reasoned that the contingent fee agreement was not an anticipatory assignment of income because the litigation recovery was not already earned, vested, or even relatively certain to be paid when the contingent fee contract was made. In Commissioner versus Bonitas, Bonitas alleged that his employer and successor employer had wrongfully interfered with his employment contract and discharged him when he refused to breach his fiduciary duties to his customers. He sued and recovered $4.864 million, and the defendants paid an additional $3.864 million directly to Bonitas's attorney. The commissioner challenged the exclusion of the attorney's fees, and the tax court upheld the commissioner. On appeal, the Ninth Circuit reversed, reasoning that under state law, contingent fee agreements operate not as an anticipatory assignment of the client's income, but as a partial transfer to the attorney of some of the client's property in the lawsuit. The Supreme Court held that when a litigant's recovery constitutes taxable income, that litigant's income includes the portion of the recovery paid to the attorney as a contingent fee. Thus, the Supreme Court reversed the decisions of the Sixth and Ninth Circuits. Now, as we mentioned here earlier, the problem for Banks and Bonitas is while those attorney's fees are deductible or were deductible, they were deductible below the line, so they were itemized deductions. And the problem was they constituted miscellaneous itemized deductions, which now would not be deductible at all. Back then, they were deductible to the extent they exceeded a floor of 2% of AGI. However, the real problem was, for purposes of the alternative minimum tax, these expenses would not be deductible and instead would be taxed at a rate of 26 to 28%. As some of the amici pointed out, in some cases, the AMT might exceed the amount of the recovery. Indeed, we talked about this in the case of Cynthia Spina, the police officer who sued her department for sexual harassment and employment discrimination. So go back and review that case in your notes when we talked about Section 104. The Supreme Court also referred to what was at the time a new provision under Section 62A20, which allowed an above-the-line deduction for attorney's fees and court costs incurred in connection with any action involving a claim of unlawful discrimination. But that does not cover all claims. And unfortunately, for Mr. Banks and Mr. Bonitas, this provision applied prospectively only, and it was enacted after their cases arose, so they did not get any benefit from it. Now, why did the Supreme Court hold that attorney's fees were included in Banks and Bonitas's gross income? The court reasoned that the agreements were anticipatory assignments of income. The income-generating asset, that is, the tree, is the cause of action that derives from the plaintiff's legal injury, and the plaintiff retains dominion over this asset throughout the litigation. The fact that the claim may be speculative makes no difference. Since the attorney contributes value to the suit, the respondents urged the court to consider the contingent fee agreement as establishing a joint venture or partnership for tax purposes. But the court declined this invitation because it reasoned that the relationship between an attorney and a client is one of principal and agent, not a partnership or joint venture. Banks further argued that under the federal statutes that underlay his cause of action, there was a fee-shifting provision, and thus his attorney was entitled to recover fees by law. The court noted this but did not address it, because it determined that Banks' attorney had received fees under their agreement and not under the fee-shifting provisions. Now, let's take a look at the problems at pages 574 to 575. We're asked to assume the following expenses are properly deductible, and whether they fall under Section 62 as above-the-line expenses, or they may be claimed as a Section 67B non-miscellaneous itemized deduction, or whether it falls into the code's Section 67G black hole for miscellaneous itemized deductions. In A, the employee salesperson pays the cost of business transportation and is not reimbursed by her employer. So remember that Section 62 does not authorize any deductions. I cannot stress that enough to you. Section 62 merely tells you where and how to take the deductions once they are authorized. So the first thing you have to do is find an authorizing provision. Employee salesperson's business transportation is assumed to be deductible under 162. It is an unreimbursed employee business expense not specifically listed in Section 62A. Thus, the expense is an itemized deduction. Remember, anything not listed in 62, if it's otherwise authorized, is automatically a below-the-line Section 63 itemized deduction. However, since it's not specifically listed in Section 67B, it is a miscellaneous itemized deduction. And so under Section 67G, it is currently not allowed as a deduction in computing taxable income. So unreimbursed employee business expenses are disallowed as a deduction, even though they're otherwise authorized as a deduction under Section 162. The disallowance includes all the unreimbursed 162 expenses, which would be not only transportation expenses, but also lodging, 50% of the cost of meals, education expenses, educational travel expenses, uniforms, dues, and fees, professional fees, just to name a few examples. In 1B1, same as A, except the employer reimbursed employee for the exact cost incurred. How should employee treat the expenses and reimbursement on her return? And what result to the employer? Well, as a reimbursed employee expense, it would now be deductible under gross income under the authority of Section 62A2A. So if you are reimbursed for your employee expense, it moves magically from below the line to above the line. Note that the regs at 1.162-17B1 broadly provides an exclusion from gross income for the reimbursement, and then a disallowance of a deduction for the expenses, where the reimbursement equals the expenses and the employee must account to the employer. So you get to exclude this because including the amount of the reimbursement in gross income and then deducting that same amount above the line produces a wash. which is tantamount to an exclusion. The employee must state on her return that the total amounts charged directly or indirectly to her employer and received from her employer as advances or reimbursements did not exceed the ordinary necessary business expenses paid or incurred by the employee. The employer can deduct the 162 transportation expenses, that is, the reimbursed transportation expenses, above the line under Section 62A1. In 1B2, what if the amount paid to the employee as a reimbursement exceeds her actual expenses? Well, in that case, the excess must be included in the employee's gross income under Reg Section 1.162-17B2. In addition, it will be reported on the employee's Form W-2, and it is subject to employment tax withholding, unless the employee received the excess under an accountable plan and returns it within a reasonable time. Generally, that's 120 days. This is under the authority of the regulations at sections 1.62-2C, G2, and H2. The balance, that is, the amount of the reimbursement, is excluded from the employee's gross income and exempt from withholding as long as the reimbursements are paid under an accountable plan. In that event, the results for employer are the same as in 1B1. If the reimbursements are not made out of an accountable plan, then the entire amount is gross income to the employee, and none of the expenses are excluded, with the result that they are miscellaneous itemized deductions subject to that black hole limitation of Section 67G. So therefore, they would not be deductible at all. In 1B3, what if the actual expenses exceed her reimbursement? Well, the reimbursements, to the extent they are made from an accountable plan, are excluded from income and exempt from withholding. In that event, the results for employer are the same as in 1B1. This is under the regs at 1.162-17B3. This allows employee a deduction for the deficiency, with the added requirement that she file a statement setting forth such particulars as the nature of her occupation and the exact nature and amount of expenses. However, the reg at 1.162-17B3 requirements are moot here because the excess constitutes a miscellaneous itemized deduction, which is not allowed in computing taxable income through 2025, and that's under the authority of Section 67G, our black hole, as the casebook refers to it. In C, same as A, except the employer, an individual rather than the employee, incurred the expense. So no problem here. Employer's transportation expenses are going to be deductible from gross income under Section 62A1, which allows an above-the-line deduction for all trade or business expenses incurred by an employer, or at least incurred by one other than in that person's capacity as an employee. If the travel expenses included lodging and meals, they would also be deductible above the line. Although remember, the meal deduction would still be limited to 50% of the cost by Section 274N1. In D, employee makes payments for medical expenses and charitable contributions and for taxes on her residence and interest on a note secured by a mortgage on that residence. Well, all the expenses mentioned here are personal expenses of the employee, so they would not be covered under Section 162. Nevertheless, they are made deductible by Sections 213, 170, 164, subject to a $10,000 ceiling on state and local taxes, and Section 163, respectively. None, however, falls within Section 62A. So consequently, none of these expenses are going to be deductible above the line. They are consequently not deductible at all unless the employee itemizes her deductions. If so, under 67B, the deductions are itemized deductions, but they're not miscellaneous itemized deductions. So therefore, they would be allowed in computing taxable income. In E, same as D, except that the taxes and interest relate to a residence that employee rents to the tenant. Well, the difference here from problem 1D is that the payments for taxes and interest now relate to income-producing property. Under Section 62A1 or 4, deductions otherwise allowed here by Sections 162 or 212, attributable to property used in a trade or business or held for the production of income, that is rent, may be claimed above the line in arriving at AGI. The medical expenses and charitable contributions remain potentially deductible, however, generally as Section 67B itemized deductions that are not miscellaneous itemized deductions. In 1F, employee has a loss on the sale of some stock that he held for investment. Well, employee stock loss is allowed as a deduction under Section 165C2 as a loss incurred in a transaction entered into for profit. And it would be deductible from gross income under Section 62A3 in arriving at adjusted gross income. In 1G, employee deducts $1,000 of interest on student loans. Employees' $1,000 of interest on student loans would be deductible under Section 221 and would also be deductible from gross income under Section 62A17 in arriving at adjusted gross income. So deductible above the line. In H, employer pays accountant $400 to prepare his federal income tax return, $150 of which is allocable to preparing for the schedule related to income from his sole proprietorship business. Under Revenue Ruling 92-29, $150 of the deduction would be allowed by 162 as directly related to his sole proprietorship business, and that would be deductible under Section 62A1. The remaining $250 would be authorized as a deduction under Section 212.3 as attributable to tax advice. But it is considered a miscellaneous itemized deduction. Therefore, it falls under the so-called black hole of Section 67G, and it would not be deductible. In I, employee is an elementary school teacher who buys $350 worth of classroom materials in the current year. Under Section 62A2D, up to $250 of the cost of those materials is deductible. And under 162, those expenses are authorized as employee business expenses. So $250 of that would be deductible above the line under 62A2D. The remaining $100, though, would be deductible under 162, but it's a miscellaneous itemized deduction that falls under the Section 67G black hole. Therefore, it's not deductible. So any 162 unreimbursed employee business expense is not going to be deductible through 2025. In J, investor Higgins, who owns a substantial interest in Exco, incurs transportation, meals, and lodging expenses to attend Exco's annual shareholder meeting. Higgins' expenses are deductible under Section 212.2. However, as they are not listed in either Section 62 or 67B, they are itemized deductions and they are miscellaneous itemized deductions. So again, they fall under the 67G black hole and they're not deductible. In K, investor Buffett, who has substantial stock holdings, rents an office, hires a staff, and incurs additional costs in relation to his investment activities. Well, unlike the unfortunate Mr. Higgins, Buffett's expenses are deductible under 212.1. They are not incurred in a trader, but they're not incurred in a trader business. And like Higgins' expenses, they are not listed in either Section 62 or 67B. Therefore, they are not going to be deductible because they fall under the 67G black hole. 1L, hobby loser has $2,000 of gross income from his hobby activity and expenses from the hobby activity in excess of $2,000. Under Section 183B2, he is able to deduct only $2,000 from the hobby. Loser's expenses, even though deductible to the extent of $2,000 of gains under 183B2, this is a provision that limits losses from hobby activities. So even though they're deductible under 183B2, they're not incurred in a trader business, and they are not deductible under Section 62 or Section 67B. Therefore, they also fall within the 67G black hole. No deduction. In 2, in view of the answers to problems J and K, should 62A4 be amended to include property held for the production of other sources of income? Well, seemingly, although Higgins says no amount of investor activity constitutes a trader business under Section 162, nevertheless, perhaps Congress should amend Section 62 to allow those deductions above the line, just like Section 162 expenses of a trader business. After all, these 212 expenses are incurred in the generation of taxable income, just like the 162 expenses. In 3, some expenses incurred may qualify both as a business expense and a medical expense. In general, how would a taxpayer prefer to treat the expenses in A if the taxpayer is self-employed? Well, if the taxpayer is self-employed, the taxpayer would prefer them to be 162 trade or business expenses, so that they're not subject to that high Section 213 10% of AGI floor. What if the taxpayer is an employee in B? If the taxpayer is an employee, the taxpayer would not be able to deduct them in computing taxable income if they were 162 deductions, because they would be considered miscellaneous itemized deductions and would not be deductible under Section 67G. However, if they were medical expenses, even though they're subject to that 10% floor, the excess above that floor, if there is any excess, would be deductible under Section 67B5 in computing taxable income. So it would be an itemized deduction that would not be considered a miscellaneous itemized deduction. So if you're traveling on business and you come down with coronavirus and you have to be hospitalized and your insurance doesn't cover all of your expenses, then you may end up with enough expenses to deduct. 4, in the Banks case, Justice Kennedy notes that these cases likely would not have arisen under the current code as a result of the enactment of Section 62A20 and E. Those provisions, however, do not apply to all recoveries, as I mentioned a bit ago. For example, what result to plaintiff if plaintiff recovers $1 million of compensatory damages, $2 million of punitive damages in a personal injury case, and plaintiff's attorney receives a 1/3 contingency fee of $1 million. So admittedly, the enactment of Section 62A20, which allows a deduction for attorney's fees in unlawful discrimination cases to be an above-the-line deduction, that alleviates the banks and bonitis issue and creates a wash in such cases. So the wash is that amount would have to be included in income, but yet 62A20 would allow an immediate deduction. However, as I mentioned earlier, Section 62A20 does not apply to all lawsuits. So the bank's issue lives on in those cases, such as personal injury recoveries. So in this problem, plaintiff would be allowed to exclude the $1 million of compensatory damages under Section 104A2. But the $2 million of punitive damages would have to be includable in gross income, as the 104A2 exclusion does not apply to punitive damages. Take a look at Section 104A2 in the first parenthetical. The $1 million of attorney's fees are not deductible in computing taxable income. First, 1/3 of those attorney's fees related to the excluded Section 104A2 compensatory damages. So that is $333,333. And would not be deductible because of Section 265A1, which prohibits a deduction incurred to generate tax-exempt income. To permit such deductibility would provide the taxpayer with a double benefit. Second, the other 2/3, that is $666,667 of the attorney's fees, would be deductible under 212(1). The inclusion deduction result is, of course, required under the bank's case. However, this deduction is not an above-the-line deduction because it does not fall under 62A20 and E, because that provision applies only to deductible attorney's fees and court costs in certain discrimination and other whistleblower lawsuits. It does not apply to deductible attorney's fees and court costs in a physical personal injury lawsuit. As a result, the $666,667 deduction is a miscellaneous itemized deduction, not deductible in computing taxable income, as a result of the fact that it is not listed in Section 67B, and so therefore it will fall within the black hole of 67G. Because of the non-deductibility of miscellaneous itemized deductions, Congress did away with the alternative minimum tax, at least until 2026. So at least this taxpayer does not have to worry about that on top of all these other problems. Our next section on page 575 is about the standard deduction. Now, the standard deduction is an assumption that all taxpayers will have some deductible expenses. So, in case you wondered why commuting expenses are not deductible, perhaps they've been factored into the standard deduction, at least to an extent. All taxpayers are entitled to a standard deduction. And the great thing about that is that you do not have to keep records to substantiate that deduction, whereas you do with all other kinds of deductions, whether it's above the line or below the line. Also, with a standard deduction, you do not have to worry about falling into one of those gray areas as to whether this is a personal or capital expense that may not be currently deductible. As I have mentioned to you before, the Tax Cut and Jobs Act of 2017 basically substantially increased the basic standard deduction. This makes it harder to take your itemized deductions because you can only take those if they exceed the standard deduction. Since, as we have seen, itemized deductions have some severe limitations, it's probably good that the standard deduction was increased. Now, the standard deduction consists of two amounts. This is the basic standard deduction, and then there's an additional amount or additional standard deduction for those taxpayers who are over age 65 and another for those who are blind. This amount, $600 for each over 65 and blind, for married filing joint taxpayers, is increased to $750 each for single taxpayers. Both the standard deduction and the additional standard deduction are indexed for inflation. Since I'm not going to go over that, I don't expect you to know what that is. Now let's look at the problems on pages 577 and 578. In problem 1, single taxpayer who is an employee of a law firm in the current year has $100,000 of adjusted gross income and the following allowable itemized deductions: $6,000 in interest, $6,500 in state income taxes, $1,500 in unreimbursed employee travel expenses, $200 in tax preparation fees, and $300 in bar association dues. For simplicity, assume there are no inflation adjustments. What is taxpayers' taxable income for the current year? So taxpayers' taxable income for the current year is $87,500. Taxpayers' basic standard deduction is $12,000 under Section 63 C2C and 63 7A 2 little i's. Taxpayers' total deductible itemized deductions of $6,000 for interest and $6,500 for taxes within the $10,000 164 limitation are deductible in full. But the remaining miscellaneous itemized deductions of $2,000 for unreimbursed travel, tax preparation fees, and bar association dues are not deductible because they fall under the black hole of 67G. Thus, taxpayers' total itemized deductions are $12,500. And since that amount exceeds the standard deduction of $12,000, taxpayer may make a Section 63 election to itemize. So, with total AGI of $100,000, itemized deductions that would be allowable of $12,500, taxpayer ends up with taxable income of $87,500. Now, a couple of things to note here. One is that the itemized deductions, your standard deduction is not a floor. That is, it is not subtracted from your itemized deductions. So if your itemized deductions exceed the standard deduction, then you take your itemized deductions. You don't have to subtract the standard deduction from it. The other thing is that if this taxpayer was a self-employed attorney, then under Section 62A1, the $2,000 of business expenses would be deductible above the line. That would result in $98,000 of adjusted gross income and then $85,500 of taxable income. So the great thing about above the line deductions is that it does not affect your itemized deductions. You still get to take your itemized deductions. In B, what difference in result if taxpayer's 65th birthday is January 1st of the succeeding year? Well, if taxpayer's 65th birthday is on January 1st of the succeeding year, then taxpayer is treated as having reached age 65 on December 31st of the current year. This is under the regs at 1.151-1C2. Now, note that Revenue Ruling 2003-72 holds that a person of a younger age does not reach that age until a day later on their actual birthday. So here, taxpayer qualifies for an additional standard deduction of $750 under Section 63 F1A and F3. When added to the $12,000 basic standard deduction, taxpayers' total standard deduction for the year becomes $12,750, and that exceeds taxpayers' deductible itemized deductions of $12,500. So now we would use the standard deduction instead of the itemized deductions. So again, taxpayer has $100,000 of AGI. We're deducting the standard deduction of $12,750, and that gives taxpayer taxable income of $87,250. In C, what difference in result under the facts of A if taxpayer is a married couple filing a joint return? So if the taxpayers are a married couple filing a joint return, then their taxable income becomes $76,000. So their basic standard deduction would then be twice the single standard deduction. So it would be $24,000 instead of $12,000. This is under Section 63 C2A, Roman numeral I, and 7A, two little i's. Since that amount exceeds their deductible itemized deductions of $12,500, they would not elect to itemize. So with their $100,000 of AGI and their standard deduction of $24,000, that would leave them taxable income of $76,000. In D, what difference in result on the facts of C? If taxpayers' deductible interest is $10,000, the state income taxes are $12,000, deductible interest is $10,000, state income tax is $12,000, and the taxpayers have a $5,000 charitable contribution. So in this case, the taxpayer's taxable income would be $75,000. This problem differs from 1C in that the taxpayers have $10,000 of itemized interest deductions, only $10,000 of state tax deductions under Section 164B6B, which is a ceiling of $10,000, and a $5,000 charitable deduction. So their total deductible itemized deductions would be $25,000, and that exceeds their $24,000 standard deduction. So then they would elect to itemize. They have AGI of $100,000. Their total itemized deductions are $25,000. That leaves them with taxable income of $75,000. In 2, T, who is single, a child of X, and a full-time law student, has gross investment income of $4,000 in the current year, and no Section 62 or itemized deductions. We're asked to assume there are no inflation adjustments either. T qualifies as a dependent of X for the year. What is T's taxable income, if any, for the current year? So if you are considered a dependent of your parents, your standard deduction then is severely limited because your parent's going to be getting an extra tax benefit by virtue of claiming you as a dependent. This applies, however, regardless of whether your parents take that tax benefit or not. So T's taxable income for the year is $3,500. Because an exemption amount is not allowable, because an exemption deduction is allowable, not necessarily allowed, to another taxpayer, then T's standard deduction is limited by Section 63C5 to the greater of T's earned income plus $250 or $500. Since T has no earned income here, T's standard deduction would be limited to $500. So T's taxable income is $4,000 less $500 or $3,500. Note that T's tax liability would have to be determined with reference to the Section 1G kiddie tax. In B, what difference in result in A? if instead T has $1,000 of earned income and $3,000 of investment income. So T's taxable income here would be $2,750. Again, T qualifies as a dependent of T's parent and is subject to Section 63C5. So now T's standard deduction is equal to T's $1,000 of earned income plus $250 under Section 63C5B. So T's taxable income then is $4,000 less $1,250, which would equal $2,750. What difference in result if T instead has $13,000 of earned income and no investment income? Well, in that situation where T has additional earned income, then T's taxable income is $1,000. T's basic standard deduction of $12,000 is potentially limited under Section 63C5. Since T's earned income of $13,000 exceeds the basic standard deduction, then T may fully deduct the $12,000 standard deduction under Section 63C2C and 7A, two little i's. So T has taxable income of $1,000. That is $13,000 less the $12,000 standard deduction. In 3, A lives in New York and B lives in Florida. Both are single and have very substantial all-salary incomes of identical amounts in the current year. Both incur $5,000 of deductible interest expense, and A pays state income tax in the amount of $9,000. B pays no state income tax. Assume, quite artificially, that neither has any other cost, expense, or expenditure that could be claimed as a deduction. Assume, in addition, that there's no inflation adjustments, which, if either, could claim the standard deduction. So, it is true that Florida has no state income tax. There are a few states with no state income tax, and Florida is one of them, which is one big reason why so many people retire to Florida. B, the Florida resident, should use the standard deduction, since B has only $5,000 of itemized deductions, and use of the $12,000 basic standard deduction would reduce B's tax liability and therefore a taxable income and therefore tax liability. A, the New York resident, has $9,000 of state income taxes plus $5,000 of deductible interest income. This gives her $14,000 in itemized deductions. Since that's greater than the $12,000 standard deduction, A would elect to itemize her deductions. I will note also that New York certainly does have state income taxes, and they are, if not the highest, they're certainly well up there as the highest in the nation. In 4, husband and wife file separate returns. Husband has substantial itemized deductions, but wife has very few. Why does Congress prohibit the use of the standard deduction by wife if husband itemizes his deductions? So if the taxpayer is married and files a separate return where the spouse itemizes deductions, then Section 63C6A prohibits the taxpayer from using the standard deduction. The reason for this rule is that without it, one spouse could pay and deduct all the itemized expenses, while the other spouse could elect the standard deduction, and they together would receive a double benefit. This would be a distortion of their tax liability. As the standard deduction is intended to replace itemized deductions, such intra-family tailoring could defeat its purpose. So that concludes the material for this term. You have now crossed the finish line, and that's going to be it. Unfortunately, this is going to be our last class together, and I'm sorry that it was not an in-person class, but I hope that you get something out of these online classes. And please remember that if you have any questions at all, contact me. You have my email address, you have my phone numbers. You can call me either at the office or at home, either one, or preferably by email so I can share that with the class. I've enjoyed the class. I've enjoyed having y'all as students, and I wish all of you the best of luck. And for goodness sakes, stay safe, stay well, stay strong. See you.